What's going on, guys? Thank you for tuning into this episode of Twin Finance. My name is Dylan. Today I'm going to teach you a little bit about capital gains tax. Before we get into the capital gains tax in specific, we need to know what a capital gain is. So when you take your capital, which would be money, in this case after tax dollars, and you take it and you grow it into something bigger, that's what's going to be a capital gain. So when you make that gain, you're going to be subject to a capital gains tax. And I'm going to break that down for you right now. So there's two different types of capital gains. One is short term, I'm just going to write ST, and then one is long term. That's the second type. Well, short term, what that means is usually under 1 year. So like, let's say you held that asset for under 1 year. That's what short term is. Usually that's where it is where I live. So what that means is short term. So let's say you bought an investment, let's say it's a stock in this case, $1,000. You grew it to $1,500. Well, now the capital gain you made on that investment is $500. So now that capital gain is going to be subject to capital gains tax. And in this case, short term, the rate is going to be all of that gain, $500, is subject to half of your income tax rate. So let's say it was a 20% rate. So I'm just going to write this down for you real quick. Half of income tax rate, ITR. So half of your income tax rate, let's say in this case 20%, so it would be 10% because that's half. So 10% of $500 is $50. So you're gonna have to pay $50 in capital gains tax on that gain, guys. The second one, long term, it's usually over a year, over 1 year. So you held that asset for over a year. So usually if you hold it for over a year, it doesn't matter if you hold it for 20, 25 years, 2 years, like it's just long term. That's what it's considered. So long term, and what that means is, say like the same scenario, $1,000, you turn it into $1,500. It's not all of the gain that's subject to the half of your income tax rate. It's only half of the gain. So if we take half of the gain, and then you multiply it by half of your income tax rate, you're actually getting a quarter. So essentially, it's only a quarter of your income tax rate. So let's say in the same scenario, $1,000, you invested it, it grew to $1,500. Only $250 of that is going to be subject to half of your income tax rate. And that's gonna work out to be, say in that case it was 20%. It's only going to be 10% tax. You're only paying $25 long-term capital gains opposed to short-term capital gains, so you're actually paying half. Well, it doesn't seem like a lot in this scenario, but if we were talking about $1.5 million opposed to $1,500, it's going to be saving you a lot of money in the long run, guys. So it's very key to know that, especially if you have a lot of money. I mean, the thing is with finance, guys, and I want to just break this down for you guys too, is it doesn't matter if you have $1 million or $1,000 or $100. You should treat every dollar the same. So in this case, the long term versus short term, like I said, if you're talking about $15 million, it's going to mean a lot more to that person. But it's all relative, guys. If you want to be rich, you got to manage your money the same no matter what. So thank you for watching this video. Remember, subscribe to the channel. Also like this video, and have a great day, guys.